Oh,
Okay, here we go. So welcome to Invest in You. This is another episode of The World is Crazy. Jokes
yeah.
aside. So today we'll talk about specifically something called private credit. And the cool thing with private credit, it's only available if you're really, really rich. And we will explain why that is the case and more. So again, this is not financial advice. This is not doomsday prophecy, anything at all. This is just me and Ivan Sandvall talking about the finance and the world as it looks today. So we usually don't date our episodes, but as we are recording this, it's the 9th of March. Why is that important and worthwhile to put into the calendar? It is because the ongoing conflict in Middle East with Iran at the center of it is very much ongoing. So we just passed a bit more than 1 week of that. So without further ado, so today we'll talk about something which most people don't even know what it is. It's considered to be one of the most stable and most best cash flowing assets if you're an ultra high net worth individual. It's called private credit. So basically, it's private. Why? Because it's not for everyone. It's credit because it's credit. So basically, institutions or companies are lending money to other companies. So I've been working with private credit in the UK previously. So we were on one side having a lender, and on the other side we had a borrower, and we took a spread in the middle. And exactly that is what we'll talk about further today. So private credit, what does it mean? So for years, there's been marketing as a very calm public thing, very high yields, often well into the double digits, sometimes into well over 20%. Stable valuations. Why? Because the underlying company has been stable and going. Otherwise, they wouldn't not even do this. This is not a corporate bond. It's less volatile because usually the money is locked in for years, 5 to 7+ years. And everything's been fine, usually. But now even the biggest, strongest companies in the world, BlackRock has had withdrawals. So we saw BlackRock selling their ETF Bitcoin the other weeks. And now we also talk about private credit that should be super safe. So we'll dive a lot deeper into that. We'll also talk about a couple of examples from United Kingdom and so on and so forth. So this is all part of what I've written about in the Abyss of Finance. When the market doesn't have trust, we are in big trouble. And that is very much linked to this. And so markets only break because you got breaking trust in a currency or companies or the system or the world economy or a major black swan event. And right now we pretty much have got everything going at the same time. So confidence
Yeah.
low, liquidity low, leverage high, lending high. Ivan.
Buffett indicator all-time high or close to.
Exactly.
Everything is leveraged long and has been so for a bit too long, perhaps.
Yeah. So let's unpack this a bit more, Ivan. So before we dive deeper, what is your current understanding what private credit even is? Just high level for the people who are 20 years old. They have never heard the term before.
Yeah, I actually hadn't heard of it either. I probably heard the term, but it's not something I'm into, obviously, as a very young person who's not yet an ultra high net worth
Yes.
individual. I understand that companies can borrow from different places, and a bank may not always be the most understanding lender when it comes to high risk, high yield type
Yes.
activities. So I would imagine that it's probably easier to just like a person, a regular person might take a loan from a friend to start a risky business venture. Maybe this is a similar thing, but for companies. And
Yeah. Yeah.
that's pretty much the level of understanding I have is what you've
Yeah.
explained. And it's very interesting as well that you can't withdraw more than that everyone can't withdraw at the same time.
Yeah. Exactly.
So maybe you can expand on
Yeah.
that a bit.
Absolutely. So private credit is really about lending outside the bank system. I say that one more time. It's outside the banks. What does that mean? you have got the terms and conditions are set up between different parties, which means it can be anything. When I was doing this in the United Kingdom, we might have someone who's got money on one side and someone who's got like a real estate project on the other side. And very much this matchmaking is an example of private credit. And this can be very lucrative. Why? Because often the people who are looking for the funding, they might use the private credit to be the equity part. And then they also add some bank lending, which means ultimately you can have more than 100% leverage.
Yeah.
Are you with me, Ivan?
Yeah, I understand. So they take double loans.
Yes, exactly. So it's
Loans from the bank and loans from the private
exactly.
lenders.
So in this case, you might have a company that looks really strong on the paper. For example, an AI company. They need to have money for
Yeah.
development, research, search, marketing spend, and so on. But when the market is tough, they are in trouble. So with that said, how does this work? Because this is only accessible to the ultra high net worth individuals usually, so you need to pretty much have at least 10 million plus to even be considered to have these options. And that means that the people who put in the biggest part of this is, congratulations everyone who's listening, it's your pension funds. So your pension is here in private credit, whether you want it or not, whether you know it or not. Also, big insurance companies are also using this to have cash flow, for they get premiums, and the premiums should last maybe many years. And now they can take your insurance premium, keep it in the bank, but the bank is now private credit, which means they have like 20% interest, and they also keep your principal. And usually you will never even claim your insurance, which means after 5 years, they have got still your money to cover the insurance, which you never claim. That's 100% of all the money. And now they got 20% interest on interest, which means they've doubled the money and you didn't make an insurance claim. It's a solid business. And you also have family office. So basically, they make 200% return on the money for zero exposure, really. Family offices, wealthy investors are, of course, prime for this as well. So this is super exciting because most people have no idea it exists. So that's why I love to dive into it. So who do they give the money to? Mid-sized companies, real estate projects. It might be so-called leveraged buyouts, so a company buying companies and more. It could be infrastructure like railways, roads, bridges, and so on. Why? Because it's long term. And it's safe. It might even be like government backed, the project. So it's part of like the whole pie of how to fund it. They might have something from the government, something from the bank, and then their own money is private credit money, which means
Yeah,
that
that is a high leverage situation.
exactly. So the equity they put into the project might be zero or,
Yeah,
or
and
negative.
if it goes well, that's probably one of the best deals of all time.
Exactly.
You
So the
get free
invest
money, and then you get a really high return.
exactly.
That's amazing.
So investors they get really high yield, and usually they have a high level of security. They also have to give up liquidity. Why? Because they usually lock in the funds for a long time, which we'll explain further what it means in a second.
Yeah, you just mentioned liquidity. Is that the main issue now? Since everyone wants to, maybe some people at least want to exit
Yeah,
at the same time.
exactly. So I've heard various numbers of this, but many of the high net worth individuals have been exiting positions to have money available to buy when there is a correction. So including Warren Buffett is right now sitting on more than 300 plus billions ready for shopping. And the same for many high net worth individuals, because when there's a big correction, that's where the money is changing hands. So the retail investors are panic selling and they read the news and they sell even more. And that means that you might have all of a sudden a 20, 30, 40% discount. So you save yourself like maybe 5 years of time by buying in the dip.
Yeah, and I think a thing which is not really mentioned with retail, it's not just that they're dumb, it's also that they're kind of desperate and they need, oftentimes you need a return. if
Yeah.
you're a retail trader because you have so little money. But if you're a billionaire, you have money for 1,000 years, so
Yes.
you can make the optimal decision. I think that's a really
Exactly.
big difference as well.
Yeah.
Retail always wants to exit when you have maybe months or even years coming down the line where you might not get your money back.
Yeah.
That's a big problem.
I'll do a side remark here, Ivan. So if you think about your wealth advisor, if you think about your personal bank man, if you think about the person writing the best news in the newspaper about what you should do with your investments, okay, rewind. The person giving you financial advice, he's an employee.
Yeah.
The investor is an employee. The person writing the news is an employee. And usually, if you would ask them, like, how much money do you have in the market? It will
Maybe
not be
not as much.
not so much. Even if they're really good in terms of giving advice, they're not giving advice to themselves because they're ultimately salespeople, usually.
Okay.
And the same with the news that are pumped into the world. The scary clickbait titles sell much better than the same educational notes, of course.
Yeah, they do. And short-term news is more interesting than long-term news.
Yeah, yeah,
So a good long-term trader investor is looking at the macro trend, but usually the news is what's happening this week or this day.
yeah, exactly. Yeah,
That's
and
a
also,
big difference.
yeah, it is really interesting right now just to like scroll and see like the thumbnails right now on YouTube. I mean, we're all in our own private little bubble, but in my bubble,
Yeah.
there's a lot about the war, obviously, because I'm working with things like that. It's also around investments quite a lot. It's about bubbles, about Bitcoin, it's about gold, oil. We'll maybe touch about those things later, but now it's just like the clickbaity front thumbnail, and that is what's scaring people a lot with just a quick scroll what's in the social media. Ivan, would you like to comment because you also right now follow a lot of things in social media,
Yeah,
like
I would say
macro news?
my feed it's been gloomy for a long time. So it's difficult to distinguish exactly how gloomy it is and when it started and so
Yeah.
on. And it's also my personal bias of believing that the correction is going to happen, which is probably making my feed more negative as well. But
Yes.
I think I've got a lot more people are like claiming that the top is in, for example, on the stock market,
Yeah.
which no one has claimed before,
Yeah.
pretty much. In my feed, there are at least some people who believe that we've reached the top for this kind of market cycle, which, yeah, and they are even counting that you're going to have continued inflation, for example. So
Yeah.
they think that we're going to have negative returns in in real terms and in numbers on the screen.
Yeah, exactly. I mean, the many of the YouTube and the podcasting warriors, they might not have been investing for so long time. I've been through a number of different market cycles. I've traded for more than 1 million easily of my own cash as in one single trading day as a day trader. I've been investing many millions in terms of real estate, and the same with business investments as well. So I'm not a beginner, but I'm a learner and I'm curious to learn more. So I will dive into one small part. I've got 4 parts from my book where that is colliding with private credit. So I'm going to mention one right now, and that is called the liquidity illusion. And what does that even mean? It means basically in the book there, the Abyss of Finance, I talk about it, and I just try to explain like you might think that your assets are very liquid, but the problem is when everyone is selling at the same time, that is a problem and the headache. Whether that's in any real physical assets, or if that's in currency, or if it's in the stock market, is hugely problematic. And even you're doing more and more trading. So the problem is here, like
Yeah,
you can't just convert
exit
everything you
liquidity.
have to cash.
Yeah, we call that exit liquidity basically. So you need to
Yes.
find a buyer for every seller in
Yeah.
equal amounts. Otherwise, the price is going to have to move a lot, most
Yes.
likely. And when you have really big selling volumes, for example, on certain days, that that just has to drive the price down, because unless there's enough bids to match that.
exactly.
So yeah, and then you have like this whole thing with like the big people. They have to really think of the big traders, the institutional traders. They kind of have to think of how they enter. It's
Yeah.
like a retail trader, we can just enter and exit, and we're not moving the market at all. But the
Yes.
biggest people, when you have like, I don't really know what size of position moves the market really, but it's probably in the hundreds of millions or billions to move a
Yes.
market, a big market. And you have this thing where they not only can they not buy all at once, they have to accumulate orders over time, maybe on down days or something, so that it's not visible. And then when you have the distribution phase where they get the move that they're hoping for, they have to sell everything in multiple goes as well, since there isn't enough exit liquidity for them. So it's a whole different game.
Exactly. So I'd like to share with you here one reason why we even have this episode is because BlackRock, arguably one of the biggest ones, and same with Blackstones. They got like big headlines right now in terms of withdrawals or people who are trying to become more liquid and what is happening. So BlackRock, their high net worth individual fund called HLEND. So HLEND is the ETF. It's had 1.2 billion in withdrawal requests, and that's roughly 9% of the net asset value in this whole fund. And they have like the rules, the terms and conditions. They're not allowed to withdraw more than 5% in a quarter, and this is almost double, and we are not even at the end of this quarter.
Is
And
it every single person can withdraw 5% of their personal investment,
no,
or is it?
it's the total withdrawal from the total fund to make sure that
So if
they
you're speedy, if you're the
again,
fastest person on the ball, if you're
yes,
speedy, you can withdraw your whole position if you're fast
exactly,
enough.
yes. And then we
Okay.
got BlackRock with B Cred. So as BlackRock Credit is again also an ETF, which the withdrawals are just under 8% of the fund assets. And the same thing there. They also got like a 5% limit. What does that actually mean? Well, just adding those two, both ETFs, both very solid players. We talk about 1.6 billion in withdrawal requests.
Yeah.
And that's quite remarkable. And it also shows that people like to be liquid for different reasons. And right now, I've got lots of macro news which are crazy, everything from oil to like
In the situation we just had, which was
yes,
like a melt up in certain things,
yeah,
it was. I think it should have been the opposite, because you have a lot of markets just moving way up all the time,
yes,
and you really don't want to have almost any cash exposure if you're pretty sure that the market's just going to go up.
yeah, exactly.
So I think we were in the opposite position like very recently,
Yeah, I
probably
mean,
just a few months ago.
ultimately, this should be super safe, but we have seen in the last few months, two major players who've been struggling in the UK. One is called MFS, and the other one is called Black Owl, and they both have exposure to collapsing lenders. So people who receive the money, they are now in distress or even like liquidation, which means you lose the principal, which is like the opposite of Warren Buffett wants. So if you can't get the principal back, that's a big minus, obviously, because you should get the principal plus interest just to be like delivering on your promise. Of course, all
Yeah.
investments, like in the small print, nothing is guaranteed, and it's at your own risk, etc., etc. So
Even real estate can burn down, and
yeah,
like
exactly.
forestry, which I'm in,
Yeah,
forest is one of the most stable and slowly growing investments. It
yeah,
just grows
exactly.
very little every year. It's really safe. And then you get a windstorm like that happened in the middle
Yes.
of Sweden, central Sweden, a few weeks ago, and your investment is completely destroyed.
Yeah. So a couple
Pretty
of
much.
problems with private credit is number one, greed and fear. And that means that how do you underwrite the thing. So how thorough are you to check like the company that wants the money, can they actually repay it? Often, because it's an ETF, there's zero transparency. Like, who did you give the money? Well, we are BlackRock. It's our business. It's not your business. And there's also might be like hidden leverage inside. And like, is there cash buffers or not? We don't know. All of these things are up to each bank to set up their own rules, which they might or might not follow. Same with like, it can be a semi-liquid or liquid. We don't know. And the problem is when you got a traditional, let's call it a bank run, when everyone wants the money at the same time, it is not doable because the total amount is not available. It might be out working or it might not even exist. And again, we are
Yeah,
not
because of
pointing.
fractional reserve banking.
Yes, exactly. But this is a different story here now with private credit.
Yeah.
It's outside the banking system and it's outside the usual legislation, insights that you might have and scrutiny. So again, we're not pointing fingers at any of the institutions or companies we mentioned so far. We're just using those as examples to pinpoint the fragility of liquidity in the market, also to put a finger on the risk of leverage and the risk of using credit to grow to the level where you can't serve your own mortgages and loans, so to speak. Okay, so Ivan, can you guess why this grew so fast, the private credit?
Yeah, well, one thing that really just stack out like a sore thumb would be the interest rate.
Yeah.
Because I mean, a government bond, they say it's guaranteed. I would really not say that it's guaranteed, but
Yeah.
on a few years time scale, it's pretty much guaranteed.
Yeah.
A very
Yeah.
high likelihood. But the yield is only a couple percentage points, and then you have inflation. So you're probably making a real yield of a percentage point or two,
Yeah.
perhaps if you're lucky. And to that, you have the risk of default, and then to that, you have the alternative cost of other investments. And then you have private credit, which, as you explained, has maybe a 20% rate of interest.
Yeah.
Still pretty safe. It's probably spread over very many different companies and
Yes.
different loans. And it's just a much more attractive offer. It's an actual
Exactly.
place where your money will grow, not just maintain.
And because it's long term, it doesn't really follow the stock market. It is just there. You get your monthly, quarterly, or annual returns as cash
Yeah.
flow,
It's like
and that's very,
diversification as well.
yeah, it's very
Like a retail
appealing.
investor might have a 60-40 portfolio with 60% stocks and 40% bonds.
Yeah.
But these super rich people maybe have that 40% or something similar in the private credit instead, which
Exactly.
is
Yeah.
a
So
brutal return.
yeah. So now let's pair up private credit with another element from the book, which is called the valuation lag.
Yeah, so
So
what is a valuation lag?
yeah, so basically, private markets are updating prices immediately, and it's also pricing in the expectations of the future. So right now we've got a war very much going on, and that means uncertainty, which means that is priced into every stocks and shares that you might find out there. Private markets and private credit, it's slow. It is just there in the background. So again, assuming that people would trust this and just leave it be, it's fine because you're going to get the money back in 5 years from now. But it does not take away the risk. And of course, it's underlying companies, they got their own risk they need to deal with. And that means that when everyone is disrupted, that means the underlying companies that has received the money and that need to service the interest, they might be in trouble. And that coming back to the underwriting again. So it means
Yeah,
that
and what happens when you have like a recession in the entire US economy or maybe the global economy?
exactly.
Uh, Not a lot of those companies are going to be making really big returns to pay those high interest rates
Exactly.
during
I don't
that
need to
time.
comment on that. It's strong enough what you just said. Exactly. So basically, you delay the price discovery. So the underlying, like how much is it worth? It is very much delayed. Okay, cool.
So then you have is leverage as well, also part of the story.
Yeah, absolutely. So again, so leverage can amplify the good and the bad. So we discussed, like, for example, having leverage trading on the stock market that can go
Yeah.
great up or disaster down.
If you don't use stop losses, and if they don't work, then you can destroy your entire account with a very small trade, which
Yeah,
is not optimal.
thank you for stating that, because I tried to hammer that into Ivan's head as well. Like, yes, you got a stop loss, but it might not work.
Slippage.
Yeah, exactly. You won't be the first one that will actually receive your sales order executed. And that means that you might be in the end of a long chain. That means that the value might drop well below your stop loss. And stop loss
Or
plus
above.
leverage, that's double trouble. Yeah.
Yep.
So borrowers are leveraged. Funds can also be leveraged because, again, you can use the whole value of the fund as an asset. Because it is an asset, because you got the money and you also got cash flow on the money, which means this is worth quite a lot of money. So in theory, you can have that as collateral to get even more money. Are you with me? So they might have raised, in this case, more than 400 billion just between BlackRock and Blackstone. So with that 400 billion, well, they can probably borrow at least another half trillion on the back of that if they wanted. And that is just
That's,
one x, not 2 or 3x.
yeah, I didn't really understand that. So they're like
I'm not,
somehow
I'm not,
taking a
I'm
leverage.
not saying that they do, but if you now got
They could.
an asset which is like 400 billion, which is cash flowing at more than 20%, that's worth easily 500 billion,
Yeah.
which means you can leverage that at least by the double or
You
more.
can borrow against
Yeah,
that asset.
exactly. And that might be tempting to invest another half trillion. Why? Because you can.
And what they investing that in. The same thing. Maybe.
Probably something else. I'm not saying this is
Okay.
happening, but again, the lack of transparency and the incentives when you're working in trading is how much money will I make, because that will ultimately influence my own budget. And I know many people being on trading desks in London, UK, Sweden. And again, when you make millions in your personal pocket every year, and ultimately the risk is not on you, it's on your employer, and the money you're using is not yours either. And the only thing for you is only upside in bonus. Can you see the perverse incentives?
Yeah, it's like a there's another word for a perverse incentive,
Yes.
but it is a perverse incentive.
Yeah. Yeah. Okay. Cool.
It was a
Yeah.
while since I read about macroeconomics. I'll probably realize it soon. The word I'm looking for.
Yeah.
Um, and then we were talking before the podcast a bit about the UK as well,
Yeah.
and that lenders were collapsing in the UK.
Yeah. Exactly.
And how is that interconnected or not with the US
Yeah, I mean,
market?
it's ultimately the financial markets are really close to each other, which means that what is happening in one area will have a spillover effect to the next one, which means, like, if there's lack of confidence and trust in the UK, that will go to the US and vice versa. I mean, this spillover effect can be very negative, and that's also probably one reason why there are more withdrawals with recent track record of defaults on underlying companies in the UK in particular. And I can see that this will most likely, of course, carry on in the US as well, with all the other risks we face at the moment, and again, the level of the basically all price of assets, and the same with inflation and printing currency and bonds and so on. It's very much intertwined. And there is a term that is used quite often in financial media. It's called canaries in the coal mine. Do you know why they
Yeah,
have canaries in the coal mines? We have mines
yeah.
where we
So
live in Sweden.
apparently, the canary is a bird and it's more sensitive than a human to poisonous gas. So you
Yes.
put the bird in a cage in your mine, and then you mine, and then you see that it dies, and then you know there's gas that you
Yeah.
can't smell.
Time to get
And
up.
if you
Yeah.
don't escape quickly, you're going to die as well, like the bird. So get
Exactly.
out. And canary in the coal mine financially may be some form of indicator, which with a
Yeah.
high likelihood is telling you to get out.
Yeah, exactly. So examples here that canaries to pay attention to could be, for example, real estate lenders, the number of defaults. It could be specialty financial firms. It could be credit niche companies. So they are very close to the private credit, but they are not private credit, and they can be interlinked and can be your early warning system if you do pay attention. Cool.
A lot of these things are pretty difficult to find as well. If you're retail, there's so many different things to
Yes.
look at, and these are probably not the official numbers that we see.
Yeah.
But and they may precede the big move, which
Exactly.
when we catch it, it's going to be too late.
Yeah.
Because the news always comes out after, not before.
Yeah.
So the real issue here, it might be like trust in that this system is
Indeed.
going to continue working.
Yeah, so really trust is around the trust in markets, trust in currency, trust in fiat currency or not, trust in crypto or not. So trust in valuations, trust in the collateral, trust in liquidity. When this start to fall down, it becomes really tricky because this leads to some kind of like redemption spike and investors asking questions.
There's another thing with trust as well, like the assets which are very stable in
Yes.
this environment, they kind of bid up, which means you can make less on those, like gold, for example.
Yes.
Everyone panicked long ago. It's really bid up. It can absolutely go much higher as well. But it really hurts to buy something which has like made 100% return already.
Yep.
So it's like, where am I going to put my money? Because I know the inflation is probably coming as well pretty soon into the
Yes.
crisis. So it's a really difficult situation, retail right now, and probably for the institution as well. Where
Yes.
do I put my money right now? And I know Warren Buffett, I think he exited most of his things like many months ago, I think. Isn't that true? Like almost a year ago or something, ages ago.
He has been divesting and tidying up in his portfolio, even
Yeah, so
including
he's
some of the best stocks in the world.
yeah, which are
To
the best cash flowing, most long term, best assets. He's getting out of those as well.
yes,
But even Warren Buffett, the interesting thing is he didn't time the top, but at least he's gotten out. I think a lot of these people right now, a lot of big people probably are wishing that they could have exited already.
yeah, exactly. But again, we are still quite close to the ultimate top that we
Yeah,
have
we are.
seen, and
And
even those,
there's been this conversation before,
yeah,
multiple times. It goes back and forth. Every time we have a dip at this point, we know the market is overvalued because we have multiple indicators which tell us that. But each time we have a dip, it just keeps getting bought up.
yeah,
But eventually that can't continue. And there are things like crude oil, for example, which can kind of topple the economy enough
yeah.
so that the gradual loss in trust becomes a bit accelerated.
Yeah. I mean, ultimately, the reasons why the war started is not known to us, and we won't
Yeah,
speculate here what the reason might be. Which means since the reasons are not clear, and the end of the war is not clear either, that means the
really not clear.
timeline is really hard to assess. Which means the global impact will be a disaster here with if you look back to any of the oil spikes historically, almost all of them have led to some element of recession, bigger or smaller. So I can't see why you voluntarily would like to trigger a recession. But I already said to you so many times that we should have already had a major correction like over the last 10 years, much deeper than
Yeah,
we in the COVID correction. But it's been fabricated by printing more money, which means ultimately we all have suffered by less consumer power, purchasing ultimately.
Less
And
purchasing power.
yeah,
Yeah.
exactly. Yeah,
And I've looked at like the wages for summer jobs, for example,
yeah,
from when I was young until now. And the real wage has been really going down, despite me getting older, getting better.
yeah,
Um, a big part of the gain that I should have had,
yes.
according to normal logic of work, is the inflation is eating it up.
Yeah, exactly. I mean, when I was like 14 years old and had my first real job, I'm guessing you will get roughly double the money now, but that's 30
Yeah,
years, 30 years difference. So if you got double the money, I can guarantee the price of everything is more than double in the last 30 years.
probably.
Yeah. Yeah.
Maybe except for smartphones, which didn't exist, pretty much.
Yeah.
So we
Well,
have we
I
have some
bought,
technology, but
yeah, but because smartphones were so new, it was basically mobile phones. So I bought one for $600. That should have been 1,800 when I was like
yeah,
17. But at that time, the prices of phones had not started to go down. Just like prices for TVs has also gone down over the years. So it's not quite the same.
it's not the same. But all of these basic materials, food, crude oil, steel,
Yeah.
everything that's kind of real and not a little electronic
Yeah.
component thing. All of that stuff has just gone up.
Yeah. So before we
Just,
completely lose
just
track of like the theme of private credit, to summarize things
yeah,
here, uh, private credit is facing challenges. Why? Because of somewhat lack of trust, which is early redemptions or inquiries to redeem the principal at a higher pace than they are allowed, which is indicating that private credit is softening and it's getting more
yeah,
insecure, which means it's even more illiquid, which means that people who would like to get the money out, you really can't because someone else beat you to it. Again, any kind of investment should be long term, not short term. But for those who are shaky and keen to get liquid now to be able to buy at a discount, you should have thought about that earlier than like in the 11th hour. We will continue to
unfortunately.
monitor the markets. Invest in you is about very much holistically about investing, but stocks, shares, global markets are linked. It's not the core theme of this podcast, but with my experience and Ivan's interest, it's impossible not to mention it. So we'll
Yeah,
probably also cover private credit card over the next somewhere in the next 10 episodes,
credit card debt.
and also keep monitoring what's happening with the fundamentals of gold, silver, oil without turning this into a stock trading podcast. That's not the purpose. It's just like awareness. We are not telling you what to do, but awareness. And that's ultimately why I wrote the book, The Abyss of Finance. Awareness. There is no recipe for what you should do. And you should have read it when I launched it in January. Read it now. A couple of months later, you see just how much closer we are getting, unfortunately. And,
Yeah,
uh, and it might be hard to get your funds liquid. There was a funny chapter of that book, Ivan, that I pulled out of the book. I'll probably do
yeah,
something about it later. It's more about like the prepper and what to do outside the personal finance, how your health and your ability to defend yourself physically or even with weapons might be beneficial, or why you need to have your own bunker. But I pulled that from the book because it might be a
yeah,
little bit over the top for the average person. But there's a reason why billionaires have got bunkers.
yeah. And on the topic of liquidity,
Yeah,
gold went down on the war news,
yeah,
which is really strange.
yeah.
So I think
At the same
people are trying
time,
to sell.
yeah.
People are probably trying to get out right now.
Yeah, at the same time, I could follow the news of physical real gold out in Asia on the war news reached 6,000, even 7,000 for physical gold. So not the market price, but the real market price where it's scarce.
In Asia.
In Asia, yeah.
In the physical market, yeah.
Because they like real gold instead of paper gold.
I think that's a reasonable take.
Yeah, yeah. So what else do you want to mention today before we wrap it up, Ivan? Anything else?
Yeah, I just want to mention that we already mentioned it, but the whole crude oil thing is probably an important thing to follow.
Yep.
Because if this is a long-term increase and it doesn't go back down, that's absolutely going to be a problem. And
Yeah.
we had that in 2022, which was pretty well timed with me being a young adult and having a car and things. And I really noticed that it makes a big difference when transportation becomes more expensive because everything is linked to
Exactly.
transportation.
And right now in the war, we have seen in the last 24 hours that major installations for oil and refinery has been bombed in Israel as well as in Iran, big time in Iran, which of course will take a very long time to correct. So this is
Yeah,
well outside the scope of the normal oil production. This is like downstream, which of course will also have impacts globally in terms of the price for a foreseeable future.
absolutely. And looking at crude oil right now, it was up at $120 and now it's 100.
Yeah,
So
exactly.
the expectation, I mean, a $20 difference in a part of a day,
Yeah,
it dropping by $20. It's a very unsure market. Like right now, right today, people
yeah.
have probably no idea what's going to happen.
Super interesting. Okay, guys, we will continue with our normal content about AI, business growth, how to buy companies, how to invest in your health, and much, much more.
Yeah,
This was a quick update on private credit. And the best way to get into private credit is just simple, just become a high net worth individual or even stronger than that. And that opens up this for you for the future after this crisis. You can go shopping. Until next time, all the best from Fredrik Sandvall and Ivan Sandvall.
thank you for listening.